The markets are in absolute chaos right now. President Trump just dropped a massive bombshell with sweeping new tariffs, and stock prices are falling off a cliff. The Nasdaq is now officially in bear market territory, and even giants like Apple, Tesla, and Amazon are getting crushed. But while most investors are panicking, I'm not. In fact, I just bought more of some of my favorite high-yield dividend stocks that I think will actually benefit from this crisis over the long term. And in this video, I'm going to break down what Trump's tariffs mean for markets, inflation, and interest rates, why most investors are getting this sell-off totally wrong, and 2 recession-proof high-yield dividend stocks that are massively undervalued right now after the sell-off. So if you're a dividend investor looking for real opportunities during this crash, you need to watch this video until the very end. Before I get into today's video though, I did want to mention that my investing group, High Yield Investor, which is actually the top ranked investing group on Seeking Alpha and is also one of the fastest growing dividend groups anywhere, I'm currently running a 20% off sale. You can get the link if you have to sign up through that link in the description of the video. It's the only link where you can get this sale. So please take advantage of that today and help determine what stocks you should be buying in this current market sell-off. Back to the video. On April 2nd, President Trump rolled out his Liberation Day initiative, a universal 10% tariff on all imports. But he didn't just stop there. There's a 34% tariff on China, 46% tariff on Vietnam, 20% tariff on the European Union, 24% tariff on Japan, and the list goes on and on and on. That's not a tweak to trade policy, that's an earthquake. Now we're seeing retaliatory tariffs start to come out, especially from countries like China. Global outrage and growing fears of a worldwide trade war. JP Morgan is now even saying there's a 60% chance of recession if these tariffs remain in place. So the markets are freaking out, and rightly so. Now the sell-off is real, but here's what most investors are missing. Interest rates are falling. The 10-year Treasury yield just dropped below 4% for the first time in months in anticipation of a recession. And what that means is that the market is increasingly expecting the Fed is going to cut rates and cut rates more aggressively and faster than was previously expected. This is because with recession risks rising and some evidence is that inflation is starting to come under control, the Fed may end up pivoting sooner than previously was expected. And that's great news for dividend investors. Why? Because falling interest rates make stable, cash-flowing businesses more valuable on a net present value basis, especially those that behave like bonds. But here's the problem. The sell-off has been indiscriminate, and so stocks are getting punished across the board, even those that actually stand to benefit from lower interest rates in a stagflationary environment. So before I get into discussing 2 dividend stocks that I think will actually benefit from this dip, let's talk about a fund that should absolutely be on every dividend investor's radar right now. SCHD, the Schwab US Dividend Equity ETF, has been one of the most popular dividend ETFs in the market thanks to its low expense ratio, diversified holdings of high-quality dividend growth stocks, and a strong long-term track record of growing its dividend. But after the recent sell-off, SCHD is down by over 11% just in recent days due to tariff fears and recession concerns. And so as a result, I think it's a compelling opportunity right now because the SCHD yield is now around 4%, and its top holdings include blue chip companies with strong balance sheets and pricing power. It also has a 13-year dividend growth streak and a double-digit dividend CAGR over the past decade. Now with bond yields falling again and recession fears rising, investors are rotating back in income-producing assets, and SCHD looks primed to benefit. That said, SCHD is light on a few key high-yield sectors like real estate and infrastructure, and this is why I'm supplementing my portfolio with 2 stocks that have recently sold off but are positioned to outperform in this new environment. So the first one I'm going to mention is a real estate investment trust called Alexandria Real Estate Equities. It's ticker symbol ARE. This is a REIT that focuses on high-end life sciences properties. ARE is down nearly 20% recently, but here's why I think it is worth buying right now. It currently offers an over 6% dividend yield that's well covered by underlying cash flows. It currently trades at a near 40% discount to its underlying net asset value, and it has expected 5.6% adjusted funds from operation per share growth rate through 2029. That's per year at 5.6% CAGR. It also has a very strong balance sheet with a BBB plus credit rating, and has long-term leases on its properties with recession-resistant tenants in healthcare and biotech. And so it should be well positioned to weather the current environment. Yes, life sciences properties are under some pressure because increasingly you have vacant office space being converted into life science space, but ARE owns mega cluster properties in elite locations that gives it a competitive position and helps it to sustain high occupancy rates alongside stable cash flows and strong and predictable dividend growth for years to come. As a result, as interest rates drop, ARE's cash flows become more valuable, not less. And as a result, I think it's a very attractive buy right now. Now, another pick I like a lot right now is Energy Transfer. It's a midstream infrastructure giant, and it does issue a K1, so just be mindful of that. But you can always buy an ETF that issues a 1099 instead of like AMLP, which is the Alerian MLP ETF, or the Global X MLP ETF, MLPA. Both of those issue 1099s, and they're also compelling bargains right now after recent sell-offs. Now, ET is down about 15% recently after this sell-off, but it shouldn't be. Has an over 8% distribution yield that is covered about 2 times by distributable cash flow. Only about 10% of its EBITDA is tied to commodity prices. Its contract include inflation-linked escalators on them to help it withstand a stagflationary environment. Has a BBB credit rating, which has been freshly deleveraged due to ET paying down a lot of debt in recent years. And so as a result, ET is very much a bond-like inflation-resistant dividend stock. And it's not just recession-proof, it's rate cut-proof right now. And yes, energy prices have fallen a lot, but that doesn't affect a company like ET very much because only about 10% of its cash flows are sensitive to commodity prices. So 90% of its EBITDA expected this year is not going to be impacted at all by the volatile energy prices. And so while the stock price is getting punished due to association with the energy sector, its underlying cash flow should be quite stable, and its dividend should not only remain stable 8%, but should continue growing year after year after year. And if the Fed cuts 3 to 4 times this year, like traders expect, and maybe even 5, it should be very attractive to a stock like ET because the net present value of its bond-like long duration contracted cash flows will only increase. So while most investors are running for the exits right now, smart dividend investors are using this crash to lock in some of the best yields we've seen in a while that are well covered by cash flows and backed by very strong balance sheets on stocks that should do just fine during this current environment. And so between Alexandria Real Estate Equities and Energy Transfer and many others like them, you can get some very compelling opportunities on your radar right now. Again, they're recession resistant, inflation protected, interest rate sensitive, and trading at fire sale valuations right now. These are the type of investments that we are targeting and loading up on at High Yield Investor and our portfolios there. So if you found this content helpful, please hit that like button, subscribe for more deep dive dividend investing content. I'm going to keep giving you updates throughout this tumultuous time with tariffs. And if you want access to my full high yield portfolio, including dozens of recession resistant stocks paying 5 to 10% yields, check out the link below and take advantage of that limited time 20% sale on new memberships. Stay calm, stay invested, and keep collecting those dividends. See you next time.